I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our latest Following the Money podcast. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. About 6 weeks ago, in our July 2nd Following the Money podcast, I said to get ready for a corrective decline in the U.S. stock market. That correction is now underway according to our tactical models, the Asbury 6 and the Correction Protection Model, or CPM, as the benchmark S&P 500 has already declined by 4% from its late July peak. You can learn more about the Asbury 6 and Correction Protection Model by visiting asburyresearch.com and clicking on Models across the top of the screen. As a side note, our August 10th premium report showed that a blend of our offensive CEF model, which is our sector rotation model, and our defensive correction protection model can potentially create a methodology to capture the performance of the S&P 500 with significantly less risk. If you are an Asbury Research paid subscriber and have not read this report, we strongly encourage you to do so. Today is Sunday, August 13th, 2023. Now let's follow the money. In our previous Following the Money podcast 2 weeks ago, I said that the S&P 500 had recently met our June 3rd target of 4,600 and commented that corrective market declines often begin once upside targets are met. The S&P 500 is now in the midst of that corrective decline we were expecting, according to both of our tactical models, the Asbury 6 and the CPM. The broad market index will begin next week right on top of important near-term support at 44.48. If broken, it would clear the way for a much deeper decline. The latest underlying support levels for the S&P 500 below 44.48 will be displayed and discussed in our premium research next week. Now let's move to sector rotation via our CEF model, which follows the money around the 11 sectors of the S&P 500. CEF is an acronym for Sector ETF Asset Flows. CEF currently retains its early July overweight in financials and its late July overweight in energy, or XLE. For the financials, the ticker is XLF. Financials have outperformed the S&P 500 by 6%, since we initiated the signal, or since the model did, I should say, while energy has outperformed the S&P 500 by 3% since its signal was first initiated at the end of last month. There is also a new buy/overweight signal in the CEF model effective on Monday morning, which is tomorrow. Subscribers can get the details on this today by logging into our research center. Now let's move to domestic asset allocation via our CARP model. CARP is an acronym for Cross-Asset Relative Performance. Our CARP model took profits on 3 open signals last week. The model exited its January 17th overweight of the S&P 500 versus the Dow Industrials for an 8% relative gain. It also exited its January 20th overweight of technology via QQQ versus the broad market S&P 500 for a 15% relative gain. Finally, CARP exited its January 26th overweight of Russell 1000 Growth, the ticker on that is IWF, versus value for a 17% relative gain. Finally, let's move to our global asset allocation via Asbury Research's US versus the world model. We mentioned in our previous Following the Money podcast that the model recently exited its May 5th long/overweight signal in Brazil. The ticker is EWZ after capturing an 18% outright gain. The model is currently overweight another South American country, Peru. So there it is, our latest biweekly Following the Money podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we move into the fall. We'll see you again right here in about 2 weeks with our next Following the Money podcast. In the meantime, make sure you subscribe to Asbury Research on YouTube for more podcasts and data-driven trading and investing information just like this. Finally, the legal stuff. This podcast is provided for information purposes only and is not intended to be a solicitation to buy or sell securities. The performance indicated from back testing or historical track records may not be typical of future performance. No inferences may be made and no guarantees of profitability are being stated by Asbury Research, LLC. The risk of loss in trading financial assets can be substantial. Therefore, you should carefully consider whether such trading is suitable for you in light of your financial condition.